Hello and welcome. My name is Caroline Hudd and I'm your host today for the ING Global Economic Update entitled Turbulence Ahead. With summer sadly in our rearview mirror, let our research team share their views of how the world and markets are going to evolve throughout autumn. We have the pleasure of 4 speakers today. Kicking off today's programme is James Smith. James is our developed markets economist. James is going to give his views on what to expect as Brexit and COVID-19 collide. After James's update on the collision, we move over to the Eurozone update from Carsten Brzeski. Carsten is our chief economist for the Eurozone and global head of macro research. He's going to take us through his views on the hangover after the rebound. Post-rebound, we mask up and fly cautiously to the US for James Knightley's update. James is our chief international economist, and he'll be giving us his views on the US, the recovery's main challenges. And our final speaker on the bill is Chris Turner. Chris is our global head of markets and will walk us through financial markets, the V gets stress tested. After our speakers, we will open lines for questions. So without further ado, let me hand you over to our first speaker, James.
Thanks a lot, Caroline. Well, I think you alluded to in the UK, turbulence is very much going to be the key word over the next few months. But let's start with the good news, and that's that the UK rebound is now well underway, albeit taking a little bit longer, unsurprisingly, to get going than has been the case with some of our European peers. There are some encouraging signs, at least at face value when you look at things like retail sales, for instance. They're back to where they were before the crisis, and that seemed quite unlikely even just a few months ago. Housing market as well, obviously looking pretty rampant at the moment as well. Now, admittedly, the picture is a little less rosy once you dig a bit deeper, and that recovery in shopping, for instance, that masks an overwhelming shift to online retail, for example. Footfall in the high street, conversely, is still taking quite a long while to recover. And there's a general sense that consumers are still a bit reluctant to return to their old haunts, their old habits, given sort of lingering safety concerns. Still, having even said that, the timing of the changes to the lockdowns, obviously most of them are at the end of June, or early July, that means we should be on the lookout for quite a strong bounce in third quarter growth, perhaps around 17% Q-on-Q. Even though the economy is still going to be around 8 or 9% smaller than it was at the end of last year, and the sense is that the recovery is going to stall as we approach the winter. Now, we released our latest monthly economic update today. I'm sure lots of the other speakers will come to this as well. We've got some new scenarios, and we're looking at the outlook really in 2 phases. Firstly, the time until a vaccine is available, so how the virus spreads in that time, but more importantly, what's the government going to do about it, and then secondly, what happens once there's a vaccine. Now, just looking at our base case, we're assuming that for the time being, the UK government can control the virus through these localised measures that we're seeing at the moment, heavily focused on restricting gatherings as opposed to reclosing the economy. Now, so far, that seems to have been tentatively successful. Regional outbreaks have obviously been kept largely in check, and there are some recent concerns about the testing system, but so far, that does seem to have coped. Now, I'd say the second part of this scenario looks at how long it's going to take for a vaccine to kick in. And we think the key thing to focus on here is perhaps less whether there will be a vaccine at all, but now more how long it will take to roll out. And realistically, we don't think this will reach a sufficient level of rollout to reduce social distancing probably until the second half of next year. So what does that mean for the UK economy? Well, if the virus can remain under control for the time being, perhaps aided by gradual improvements in the testing system, then that should at least contribute to more confidence when it comes to safety among consumers. So that might help, see a few smaller incremental increases in consumption over the next few months. But of course, the flip side, and unfortunately that's going to be offset by the fact that unemployment looks set to rise through the autumn. There's potentially up to 1 million people already being classed as inactive as a result of the pandemic, but who are not actively yet looking for work, so therefore when the official numbers aren't yet counted as unemployed. And if you combine that with the potential for job cuts as the furlough schemes unwound, I think the jobless rate unfortunately could hit probably 8 to 9% by the end of this year. course, though, the pandemic's only one challenge for the UK. The other one's obviously that we're now only 4 months away from the end of the transition period. Will there be the Brexit deal? Well, as I say, time's running out. Both sides, the messaging is kind of a bit like a broken record at the moment. And that October deadline we've all been working towards is likely to be missed. Now, what happens? What needs to happen for a deal? Well, the UK has got to put forward a plan on state aid. Just to recap, this is the most sensitive issue in talks at the moment. The EU's worry is the UK could start subsidising and supporting industries and put European companies at a disadvantage. So what's the possible solution? Well, the EU's going to have to drop, or perhaps it already has dropped, its insistence that the European Court of Justice oversees the state aid rules. But the UK will instead need to come up with a credible way of demonstrating that it's not going to meaningfully diverge from the way the EU acts on state aid. That probably involves having an independent regulator to oversee it. And it adds a complication that independent body is going to take a bit of time to set up. So the EU may insist on a bit of an interim period where the UK abides by European state aid rules. So in other words, it's still a pretty tough nut to crack, but we do still think a deal's still narrowly the most likely outcome this autumn. That's partly because the political tides do seem to be turning in favour of a deal. I mean, the polls are narrowing. We know the current government is heavily influenced by those polls. The government's also under pressure with Scotland. That's the deal scenario may leave it open to easier criticism from the SNP and also, of course, more vocal opposition now too. So if we were to sort of non-scientific probability on it, perhaps you'd say there's about a 60 or 70% chance of a trade deal being done over the next few months. But of course, still is a pretty sizable risk. So what would that mean for growth next year? Well, of course, it's common hypothesis, I guess, maybe the one the models point to that we would expect a big sharp drop in GDP in early next year. So that's to happen, though, we could see a real plunge in consumer spending, and that actually looks quite unlikely, at least to be the result of Brexit in isolation. Now, if you think back to 2019, one of the surprising things was actually consumers weren't that fazed by the Brexit deadline, the prospect of no deal. Unlike firms, they didn't, there wasn't sort of panic buying or stockpiling. You could still get your toilet rolls. Instead, faster spending over the winter is going to be much more heavily determined by what we were just talking about, the jobs market, but also the government support packages as well. That's that briefly in a minute. But there will be impacts, of course, once the transition period ends. It's not true to say that the enormity of COVID-19 will make the effect of Brexit invisible. We know, of course, that the primary way it's going to hit the economy is through costs. And the key thing to remember is it's not necessarily the same types of businesses that are being hit by COVID that are going to be affected by the transition. And even where it is the same industries, the way Brexit is going to hit those terms is going to be different. It could compound the costs that are already being accrued as a result of the pandemic. Two very quick examples. Car industry, of course, has been heavily affected during the pandemic. Production fell 70% in the second quarter. Cars are a big export to the EU, but if there's no deal, there'd be a 10% tariff in place. And even if there is a deal, there's going to be some initial disruption at the ports. Now, how do you kind of deal with that? Companies could raise stockpiles, but of course, the cash flow already under pressure. Warehousing space is going to be filled up. That's going to be a pretty unattractive option. Now, at the other end of the spectrum, you've got industries less affected. Agriculture haven't really been hit too hard by COVID so far, but are the most vulnerable sector to tariffs. Often it's in excess of 30% for some products. And we know as well the sector is going to be most impacted by the new border-related bureaucracy as well. So there are going to be new costs that are different to COVID. Now, if there is a deal, it's going to help a little bit, alleviate some of all of those pressures. It will avoid tariffs, of course, but firms will still need to abide by rules of origin, which can often be just as much of a faff. Secondly, you've obviously could open the door to various measures to ease the pressure on ports. So they could, for example, when it comes to checking animal products, they could say, okay, we're going to check far less of the goods that are coming through to kind of minimise how often that's happening. You could also get trusted trader schemes. That will all help to minimise the friction, some of the friction at the border at least. Now, interestingly, there is still the possibility of some kind of minimal extra transition period that could come through. There's been, in theory, suggestions that both sides could say, the UK could, for instance, stay in a customs union for a temporary period of time to give firms more time to prepare for the eventual changes. Now, if, and I think to be fair, that is still quite a big if, that kind of thing is agreed, it would also be most beneficial for those sending goods to Europe, where otherwise border checks are going to kick in on day one. Now, how likely is that extra kind of transition? There's been a lot of talk about it recently in sort of legal circles. It's going to be complex and time-consuming to agree. So I don't know how likely it is to happen. The government also has a long-held preference to avoid delay, but I think we shouldn't rule anything out when it comes to January the 1st next year. Now, just wrapping up, what does that all mean? Well, clearly, whether there's a deal or not, the situation is still going to be quite far away from where we are now. The bureaucratic and cost burdens of all of this uncertainty is going to be much higher than it is now when we move into next year. So while we may not see that big sudden hit to GDP from Brexit, the additional strain on firms will probably put the brakes on the overall post-COVID recovery. The consequence might be that spike in unemployment I mentioned might persist for a little bit longer, broadens out to a wider range of sectors than might otherwise have been the case. Now, for the Bank of England, that's just another reason to look for a further round of stimulus in the autumn, in November. Now, we think probably this will primarily involve more QE. I think the jury's still out on negative rates. What they might do instead is kind of look at the term funding scheme designed to encourage lending to small businesses and kind of move that interest rate lower as a first step. Pressures also, of course, on the Treasury. Unlikely now they're going to follow some European partners and extend the furlough scheme, but what they might do, I guess, is flip the thing on its head, kind of reinvent the scheme to kind of offer subsidies or support to firms that create jobs. We've seen some early examples of this in the form of the Kickstart scheme, which is looking to help fund apprenticeships. So I think that's the kind of thing we've got to look for in the autumn. There will be elements that add support, but of course, one way or another with the furlough scheme, the risk is, of course, that the UK still has a larger unemployment rate than its European peers, which will inevitably add further strain on this next phase of the recovery. And on that slightly downbeat note, I'll hand over to Carsten to speak about Europe.
Thanks, James, and hello everyone. Yeah, on the eurozone, Caroline already talked about the hangover after the party. I think the party started with the first hangover, namely that we had all the growth numbers for the second quarter. And I think what was apparent there was that there is a very strong correlation between the strictness and the duration of the lockdowns and the negative impact on economic activity. So that is something that all governments have clearly put down in their books, and also explains why when you now listen to European governments, that they are extremely reluctant to say that they would repeat a similar lockdown as we had them in March, April, and May. Third quarter will be an extremely sharp rebound, and probably stronger than the rebound we will see in the US and in the UK, because when you just look at the let's say the hard data we had until the end of June, keeping it unchanged at the level of the end of June throughout the third quarter would already provide some decent growth of 4 or 5% Q&Q, and it will be more. Judging from all the let's say experimental, more real-time data, we see that especially the northern European economies are already back to something like 90, 95, in some sectors even 100% of their pre-crisis levels. It is definitely not all sectors, and it is mainly the northern European economies and not so much the southern European economies, because the southern European economies, and this is where the hangover after the party already starts, the southern European economies have hardly seen any touristic activity in the third quarter. So this rebound, which will be a V-shaped rebound, will be much more accentuated in the northern European countries and will be clearly weaker in the southern European economies. Add to that the fact that up to now, the fiscal stimulus inserted is much bigger in the northern European economies than in the southern European economies, and we already have a small hangover feeling in the third quarter. Going into the fourth quarter, I think this is the whole thing. We could see already something like a double dip, because it is normal that if you have this V-shaped recovery, if social distancing remains what is our base case scenario, that then economic activity will flatten out in the fourth quarter, and there is a risk, also a bit depending on how global trade will evolve in the fourth quarter, that the Eurozone could at least have a technical double dip. Not our base case scenario, but clearly a risk. You might also then ask, but we heard and read so much about this European Recovery Fund over the summer. That this is a fantastic thing, finally tackling the fragmentation of the Eurozone. And my answer is yes. It is politically a huge achievement. It is symbolic because it showed that there is European solidarity. That Europe can get its act together. The only problem is the whole fund has not become effective yet. So at the earliest, it will become effective in 1st of January next year. So which also means this pan-European fiscal stimulus, which was meant to be a bit of a transfer to narrow the differences between the northern and the southern European economies, will only start to hit in the course of next year. In my view, probably not before the summer of 2021, because we know how long it takes before public money then is really reaching the real economy. So therefore, this entire theme of a possible divergence of the Eurozone economy could return quicker than some in the markets currently think. The double dip, and then say looking beyond the end of this year. So how big is the risk of a double dip? It all depends on government action, because like James already hinted at, the big trump card right now for at least the growth forecast for European economies is short-time work. It has supported the labor market. In our latest monthly update, we've also there provided a nice analysis on where unemployment rates would stand in the Eurozone without these short-time work schemes. And the interesting thing is that we now see that governments know that this is a trump card and have started to extend these schemes. Germany is kind of leading the crowd here because they just extended their short-term work schemes from 12 months to 24 months. So this now really reaches into the year 2022. And is this all economically driven? Not really, because in my view, it also plays an important role that we're going to have elections next year in Germany, and that the current government clearly doesn't want to go into an election year with a surge in unemployment and also not an increase in the VAT rate, which is the reason why we still think there is an option that this temporary VAT reduction in Germany might not be reversed by the start of 2021, but we could see an extension of it. This lower VAT rate in Germany is also one of the reasons why headline inflation in the Eurozone has come down again. So we're flirting more with 0 currently than flirting with 2%. The core rate and also inflation expectations are somehow fluctuating around 1%, which means that the ECB is clearly far away from reaching its target or goal to bring inflation back to close to but below 2%. An additional concern for the ECB now has been the strengthening of the euro. Chris will also talk about the strengthening of the euro, but for the ECB, it matters. Even though in recent days we've heard different voices, we have Isabel Schnabel saying, okay, it does not really matter. Philip Lane said it does matter. This morning we had an interesting FT story where it was also reported that more ECB members actually do see this as a concern. What is the concern? The concern is not so much that exports of European companies would falter. I think these companies currently have completely different problems, challenges, and issues than just a strengthening of the euro. But what matters is that with this stronger euro, the inflation projections have to be revised downwards. The ECB uses technical assumptions, and if you just play around with these technical assumptions, you update them, you use the current market exchange rate, and then mechanically the inflation projections of the ECB would have to be revised downwards. Remember that in June, with the last ECB projections, inflation was at 1.3% for the year 2022. If this is now revised downwards to, again, something like around 1%, the ECB has an issue, which is the reason why we still think that, given that the European Recovery Fund will not become effective before the start of next year, with inflation projections being revised downwards, and with an increasing risk of this hangover and the weakening of the recovery going towards the end of this year, the ECB will once again increase QE before the end of the year. The only interesting question here would be for the technical nerds: will they do it in the current PEPP program, so the QE program targeted to tackle the pandemic, or now that they somehow solved this issue with the German Constitutional Court, could they also increase the former QE program, the APP program? But bottom line is, we expect the ECB to increase the volume of QE so that they will at least be actively purchasing bonds until the end of 2021. And with this, I hand over to James.
Hi, everyone. Yes, morning. So in terms of the United States story, we've had obviously a peak to trough fall in economic output of, huge scale, 10% peak to trough. But as the lockdowns were eased relatively early in the US, we've had quite a vigorous recovery in economic activity that started in May and, of course, continued through June and into July. And it's really been led by the consumer side. Part of that has been pent-up demand as we've escaped the confines of our apartments and our homes, and we've re-engaged with the economy. But also, I think we have to give a lot of credit to President Trump and the package that he generated. Whereas in Europe, we've seen these furloughing schemes, which has basically been the public sector subsidizing private sector salaries. When the US, they didn't do that. What they did is they've had sort of the clearing out of the labor market by basically having unemployment surge higher. But those people who were unemployed or who are unemployed have been receiving $600 extra per week as a federal unemployment benefit boost. So that has really helped to maintain incomes. And actually, it's gone over and above that. So 2/3 of people who have been receiving unemployment benefits, and there's been 30 million of them, have actually had higher incomes than when they were having than what they were having when they were actually working. So that massive income boost has been a real factor that's driven the US consumer spending story, and why the numbers out of the US have been so good over the last couple of months. Now, unfortunately, we are starting to see some more mixed news, shall we say. There has been a renewed spike in COVID cases. This really started after the Memorial Day holiday, when a lot of individual states took the decision to relax their lockdowns. We saw the number of COVID-19 cases spike higher. This was leading to higher hospitalization rates. And of course, state governors were starting to worry about what that would mean for their regional health sectors and the hospitals. They cope. So what we have actually seen is a lot of states actually reverse course and backtrack on their reopening strategies. And many states, like here in New York or New Jersey or Connecticut, basically they didn't carry through with their planned initiatives to reopen over a certain timetable. So effectively what we've seen is the reopening story stall. in the United States relative to the US, relative to Europe. And we can see that in the Google mobility data that both James and Carsten have referred to. So as a result, that's had a triple impact on the US economy. One, you've got the consumer confidence, which has been hit hard. August consumer confidence hit a new cycle low. So even, the peak of the lockdowns, confidence is now actually lower than when we were there. So that just underlines the anxiety, partly about health, but also about what this all means for jobs. Because, going through a reopening and then going through a reclosing again has obviously hurt businesses and has led to some more job losses. So that's the confidence issue is a worry. The second is indeed that employment situation. We look at various high-frequency indicators on employment. One of them is the Homebase Index. So if you've got access to a Bloomberg screen, just type Homebase. And this is a payroll tracking company for small businesses, and they've got about 1 million people on their books in the United States. So it's actually a really good barometer of what's going on in the US jobs market. And if you look at that chart on Bloomberg, you can see it's just flatlined since the 4th of July holiday. Then the third aspect that's caused me worry is the income impact, because as I said, that $600 per week federal unemployment benefit boost, which Donald Trump has introduced, well, that's ended. Now, it is being replaced by something smaller, $400 or $300 per week, but it is an income hit for quite a lot of people, and that anxiety impact is then feeding through. So you've got this triple whammy, the confidence, the employment, and the income story, which is all starting to move a little bit more negatively for the US. And we can see that in the data already. High-frequency indicators for consumer and credit card lending have flatlined, basically, over the last month. We can also see it in airport security checks from the TSA. They've just stalled at about 70% below where we were before the crisis. Hotel bookings have also started to edge lower, and restaurant bookings have also stalled somewhat. So, we've had a great story in terms of US economic activity for May, June, July, but I think August and September it's going to be much, much more challenging. And that's why we think, we've had a vigorous third quarter, but the fourth quarter growth number is going to be more subdued. Probably probably about 5% annualized, so well down on the 26% annualized growth we're expecting for the third quarter. And even with those good figures, we've got to remember the US economy is still going to be about 3.5% smaller than it was at the end of last year. And our best guess is that the US economy will not fully recover all of its lost output probably until early 2022 as best case. Because not only have we got those short-term hindrances for economic activity in the US, we've also got some medium-term concerns, and those largely center on this upcoming election. Now, the election on November the 3rd, you couldn't get a starker contrast. You've got Donald Trump, who's proposing lower taxes, lower regulation, tighter immigration, a bit of infrastructure spending, tough on China, tough on trade, etc., versus a much more internationalist Joe Biden, who's proposing tax increases. He's proposing big spending increases. He's proposing more regulation. So, as I say, the contrast couldn't be starker. Now, in the polls right now, Joe Biden is in the lead, but I would caution Donald Trump is actually narrowing the gap. And a lot of this is really stemming from the violence and the protests that we've been seeing, and he's been pushing very, very hard on the law and order ticket, and that is actually starting to gain some traction. And it'll be interesting to see. We've got the debates coming up. There's going to be 3 presidential debates, and if Joe Biden performs as he did during the Democrat debates we had early in the year, then again Donald Trump could eat away at that lead. So, for now, it's looking pretty good for Joe Biden, but ideally he wants the election tomorrow. That's not the case. The election is in 2 months, and there's a lot could change. Also, the big thing that's here in the US is, of course, mail-in ballots. This idea of postal voting, which is quite common in Europe, for example, but here it's not. And what we are seeing is this greater acceptance that postal ballots is going to be the norm. But, of course, there's a question of funding, and can the US Postal Service really deal with this? Now, this is really playing into Donald Trump's hands, because the Republicans, there was a survey by NBC and the Wall Street Journal last week, which suggested that just 10% of Donald Trump's supporters would do a postal vote. 50% of Joe Biden's supporters are looking to do a postal vote. So that just highlights why Donald Trump's really dragging his feet on the postal vote situation. So as I say, it's still too close to call, and I wouldn't put money on where this election is going. I would just caution about that. So that's why we're seeing volatility indexes. If you look at the VIX index, the volatility surrounding November, the election date, has really rocketed. And that could be the catalyst for a broader equity markets correction. Equity markets in the US really struggling to be justified by the economic fundamentals, shall we say. There is a growing anxiety, certainly amongst corporates here, but also amongst investors, that actually November could be a tricky period, and that could see some momentum. So we're increasingly seeing a lot of US corporates thinking about trying to get funding done and dusted well ahead of that. So that's something to perhaps consider. Just rounding out longer term. So we've got those short-term hindrances for US growth, the confidence, the incomes, the employment, the medium-term constraints, which is the election and the worries about what's going to unfold there. But of course, you've still got the long-term aspects of structural change. I mean, the US is really dependent on retail, hospitality, travel, disproportionately large industries in the USA versus Europe. And these, of course, are going to be continuing to be constrained in an environment when we just do not know on the part of the vaccine. Sure, we've got hope and aspiration, but is it going to be effective? What's going to happen there? How long are the containment measures going to be in place? How long will an inoculation program take place? Again, huge uncertainties. So I'd just be a little bit cautious on the growth story, especially when we look at it in context of where US equities are currently priced. Just finally from me, you may have seen last week the Federal Reserve has changed its framework for deciding how it determines monetary policy. Before, they used to say we're targeting 2% inflation and we need to preemptively raise interest rates before inflation gets to 2%, because otherwise we've left it too late and inflation could get out of hand. Well, they've had a complete 360 on this, saying, well, actually, that didn't work for the last decade, so perhaps we're going to try something new, and we're going to target this average inflation targeting, because they're saying inflation below 2% is just as bad as inflation above 2%. So as a result, averaging inflation targets. So it doesn't really mean a great deal because we're not going to be getting inflation. We've failed to get inflation in the US for the last decade. The inflation number has only hit 2% on 13 occasions out of the last 128 months. And that was during a time when the economy was booming, unemployment was at 50-year lows, taxes were being cut, etc. So how on earth are we going to get inflation now when the economy is 10% smaller and unemployment is 12 million higher? I simply do not see it. So inflation not an issue in the near term, but we could see some yield curve steepening on this, which is incentivizing US corporates to get a bit more issuance done now. And that's really reflecting the fact that, over 30 years, if you're doing a 30-year bond, yeah, it's fine to say there's no inflation for the next 2 or 3 years, but we just don't know that. And if the Fed is taking its eye off the ball on inflation, then it could be that I want to demand a little bit more premium for investing in those issues. So that is why we think there could be a little bit more yield curve steepening, this idea that the Fed is going to be more relaxed about inflation, not just over the short term, but over the medium and longer term. So some interesting things there, but I shall stop now and hand over to Chris.
Thanks very much, James. Yeah, it's fair to say that financial markets are very much priced for a V-shaped recovery right now, just looking at across a few of the asset classes. So the MSCI World Equity Index has recently pushed up to all-time highs, led by gains in technology. And with a 28% weighting for technology in the US S&P 500, the US markets have clearly done well here, as have some of the large markets in Asia, places like China and Korea. European equities have actually lagged and still down 10% year to date. In terms of fixed income as an asset class, it's performed well. US treasuries are up 8% on the year, corporate debt up 7%, and even US high yield funds are up 2% year to date. So, in fact, credit indices price default rates at some 2.5%, way lower than what was seen during the financial crisis, and effectively allowing for no day of reckoning when it comes to the corporate sector and defaults. So our credit team still feel these spreads are too narrow, or at least this remains a great opportunity for corporates to tap debt markets. Commodities, they're still down 10% on the year, largely on the back of light energy, but industrial metals indices are now rallied 32% off their lows, with a weaker dollar, no doubt, playing a role. And of course, in the FX space, we've got the dollar 10% off its spike highs in March. European currencies are outperforming, but some of the big beasts in the emerging market space, like Brazil, Turkey, ruble and rand, they're still heavily down on the year despite recent gains. So what's the prognosis? Well, I think it's important to look at asset class performance in context of the economic cycle. So most fund managers believe we're in the early stages of a recovery cycle rather than mid-recession. And if our baseline swoosh scenario does indeed play out, that early recovery view is probably the correct one. And typically that story, if policymakers have been successful in restoring confidence, and obviously Carsten and others talked about risks of sort of double dip, etc. But if they've been successful in keeping confidence alive and inflation expectations high, it's a reflationary one. So that generally should be good for commodities. It should be good for equities. And as James mentioned, yield curves should be starting to steepen as bond investors price a return of inflation. I suppose the challenge this time around is that bond curves may not steepen as much as in prior cycles. Indeed, the 2 to 5 year sections of curves may stay very flat on the assumption of lower rates for longer. Porigavi's discussed that in this month's monthly. Added to that, we've got the Fed seemingly ready to step in with yield curve control should the long end get out of hand. So here, in terms of our baseline view from the team, is that US Treasury yields hold around the 75 basis points area into year end, gently rise to 1% next summer and 1.25% by the end of 21 as part of a mild expansion. So those modest rise in nominal yields brings us to the question of real yields, and that's a really hot topic in financial markets right now. So that's the big decline in US real yields, i.e. nominal yields adjusted for inflation, or more commonly by inflation expectations. So I think policymakers have really done a terrific job here turning these inflation expectations around. On some measures in March, US inflation expectations were as low as 60 basis points, but these recently have risen up to 1.8%. And this has pushed real US Treasury yields down to -1%, weakened the dollar, and pushed investors out along the credit curve, a move very much supported by the Fed. That's their intention. Now, probably the biggest risk to this negative yield story and everything that goes along with it is another shock, as my colleagues have discussed, something that would hit inflation expectations and drive an unwelcome rise in US real yields. And probably given the nature of this summer's asset market rally, which has been a slow and steady grind higher and lots of much cross-correlation between asset markets, the style of the correction, and James has mentioned November perhaps, could be very abrupt. But I would think with this Fed backdrop that it will be relatively short-lived. Our call, however, based on our baseline scenario, should be a benign one for asset markets into 2021 as the Fed tries to run the economy hot and looks prepared to add more liquidity when necessary. This environment looks bearish for the dollar in our opinion, so we're revising our end 2021 euro-dollar forecast up to 125 from 110, and it also should be good for flows into emerging markets where, in a way, the Fed is exporting easier policy via a weaker dollar, and in practice, trading partners may be forced to ease policy even further to offset appreciation of their local currencies against the dollar, and that's what Carsten has discussed today, of effectively the stronger euro at the margin, contributing to perhaps some ECB easier policy later this year. So just finally on the presidential election, which James has touched on, in the FX space, so the common narrative is that Trump is good for the dollar through loose fiscal policy and more protectionism. Those were the stories that dominated the dollar in 2018 and 2019, while Biden's fiscal mix and his more multilateral approach to trade should be a mild dollar negative. But as we've seen so frequently, narratives in FX markets, narratives can quickly switch. But on balance, though, we would see the threat of a contested US election as a clear and present risk, suggesting that the dollar does stay fragile into November and into year end. That's it from me. So now we go back to the operator for questions. Thank you.
Hello. Yes, we've had a couple of questions coming in about the US. So I'll direct those over to you, James. So the first one is, whatever the outcome on November the 3rd, do you see any common priorities for the new Congress in 2021, such that they have a better chance of materializing? And the second question that's come in for you as well is that you talked about risk of contested US election with no one conceded. What could happen then? And how could it be resolved, and what would it mean for markets?
Crikey, okay.
Yep.
Yeah, so So on the first one, as we've seen, I mean, there's been big talk over the last month or so about the need for another fiscal stimulus, and the Democrats and the Republicans are just so far apart on this. Now, if we see Donald Trump again being re-elected, I see very little prospect of a meaningful dialogue being constructed out of this, because we know that this is going to be an immensely divisive election. There's going to be all sorts of blood on the floor between the two sides on this, and I think it's going to take a period of time for wounds to heal and people to be prepared to come around the table to seriously sit down and discuss big stimulus. So that's my caution on that. Now, if we do see Biden win, and maybe we start to see the animosity levels drop away, there is the potential perhaps for a more constructive dialogue to be agreed. Now, it also depends on the outcome of the Senate and the House race, because basically, if Joe Biden get a clean sweep, so the Democrats win the House and the Senate, then he can pretty much get his whole platform through pretty easily. But again, the prospects or the polls suggest, while the Democrats will almost certainly win the House, it's going to be a much tougher call on the Senate. So that there is the potential that we could see the Democrats working with some moderate Republicans on a deal. So I think, there's still a prospect of a meaningful infrastructure plan to come through that can see sort of, maybe $1 trillion or $2 trillion even being focused over the next 2 to 3 years on travel, infrastructure projects, those sorts of things that could really help to generate growth and generate employment. As for the contested election, then yes, as I suggested when I spoke in my prepared comments, Biden's in the lead right now, but Trump is closing the gap. The law and order debate and the debates as well, Joe Biden could come under a lot more pressure. Add in the complexity of this mail-in ballots, which is seemingly favouring Donald Trump as well, given the lack of funding for the postal system. It could well be that, Donald Trump refuses to concede or Joe Biden refuses to concede. And this, of course, we hark back to what we saw in the year of 2000, so 20 years ago between Bush and Al Gore. There were some wafer-thin margins. I mean, Gore won New Mexico by 366 votes. Bush won Florida by just 537. And it was Florida that was really critical, and it required a recount. And it took basically 5 weeks before we got an outcome. There were disputes over dates of postmarks on mail-in ballots. There were bags of postal votes that were suddenly found out of the middle of nowhere. And this got all very, very, quite unpleasant, shall we say. You may remember the term about the hanging chads and the difficulty in counting ballots and stuff like that. And in the end, the Supreme Court had to step in, and it was the Supreme Court decision which said, look, we're going to end the voting today. So the event ends at midnight today. Whatever the outcome, that is the president. And that is what I wouldn't be surprised to see happen once again, is that it gets too close to call in a couple of states that really determine the outcome, and that does lead to legal challenges. And it could be a number of weeks. For example, the 2000 election was held on the 7th of November, and it wasn't until December the 12th that we actually got the actual outcome in favor of George Bush. So, you can imagine that this would only add to the animosity, the bile and the hatred and the anger that goes on in the US. You can imagine protests going on in many, many cities. You can imagine violence. This could really kick off. Add in sort of these militia elements and the QAnon conspiracy theorists. And I do worry, it sounds a bit crazy, but you do think that this is a scenario that could really happen and can really shake confidence in the US. So it's just something to bear in mind. Watch those polls, just see how the numbers are drifting, and if Trump is narrowing the gap, be prepared for more volatility over that November period.
Okay, so I've been emailed another one. This one looks like it's for Carsten. What does the political calendar look like for Europe? Could we have 12 months of relative plain sailing by European standards?
Very good question, Caroline. By European standards, yes, because there won't be real major elections. What is coming up next spring is the national elections in the Netherlands. Well, normally there should be nothing that really excite financial markets, also given that I think there doesn't seem to be a risk that a populist could come in as number one, unlike we had with the last elections. And then later in the year, we have the German elections, obviously then marking the end of the era of Angela Merkel. But also when you look at least at the current polls, this looks like a coalition of stability as a result. So be it with the Christian Democrats and the Greens, or be it again Christian Democrats and Social Democrats or something else. But nothing really, I think, should derail markets. So therefore, from the election calendar, I think it looks like a rather smooth 12 months. Having said that, it is still Europe. And especially on this topic, European Recovery Fund, I think it is very easy to expect some noise. And this noise could be in the form of countries hand in their investment plans, so their plans they need to hand in order to get the money from the European Recovery Fund. And then some other countries saying, well, this is not what we had hoped for. Please go back. You won't get money yet. And so therefore, I think we had quite a stretch of very positive political news over the last couple of weeks, maybe even months. More integration, better cooperation, and it might even be too good to be true.
Thanks, Carsten. And I see that I've got one last question here. Bank of England question. So for James, the Bank of England seems reluctant to use negative rates right now. How would conditions need to change before the Bank of England more seriously considered using them?
Yeah, no, it's a good question. I mean, over the last few months, we've basically seen the Bank of England drop its kind of long-standing scepticism of negative rates in favour of, I guess, a bit more of a shoulder shrug. So they're kind of saying, well, it's in the toolkit, but we're not sure whether we actually want to use them. I think it really depends what happens over the next few months. A few things I'd say, though. I guess, firstly, if they were to do anything, we kind of reckon, I think actually a lot of analysts are now in the same boat, thinking that probably what they do first is look at their term funding schemes. So this is the policy that incentivises banks to increase lending specifically to SMEs at the moment. So they could change the incentives around that, maybe cut the interest rate there to negative to encourage more targeted lending. And that might be a first step. What else? I mean, the decision on whether to go more widely for negative rates seems to hinge on the state of the banking system. They had this whole spiel in their latest report where they were citing recent research from the ECB, basically saying that negative rates are kind of more effective if banks are healthy, sort of depending what state they're in, and the implication is if they're not healthy, for example, if loan losses are going up or deposits are falling, then negative rates might put more pressure on banks to kind of cut lending. Now the bank's basically saying, well, the banking system's in good health at the moment, but of course we're entering a difficult phase of the economy, which I think, reading between the lines, signals that they're going to be a little bit wary of going down the negative rate route just yet. But I think we would rule it out over the next year or so. It kind of leads me on to the final point, I guess, which would be that the Bank of England under Andrew Bailey seems to be much more in favour of using QE as its marginal policy tool. So if the Bank of England wants to add more stimulus, it's really looking at QE. It's going to, the amount will obviously be intrinsically linked to whatever market conditions are at the time. And conversely, when the Bank of England eventually comes around to tightening again, it's increasingly clear that they'll look at shrinking the balance sheet before they start raising rates again, which is quite interesting, quite a departure from what they would have done before.
Thank you, James. We'll end it there, and thank you all for joining, and thank you to our speakers. If anyone has any further questions which they'd like to pick up with any of our speakers, please do not hesitate to reach out to me or your ING contact. So once again, thank you for joining, and have a great rest of the day.